All right, welcome everyone to another Rocket Dollar webinar. We have Chris Carlsey here, a returning guest from Kirkland Capital Group. Chris, we've already done a couple great webinars, so I encourage people go look at the ones in the past too when you get some other time. But Chris, why don't you introduce yourself for maybe some first timers here today and what we're going to talk about?
Sure. Hi, I'm Chris Carlsey, and I'm the Chief Investment Officer for Kirkland Capital Group. There's my quick little background. I've spent most of my career, started off in traditional investment management, managing people's money on a discretionary basis, mostly long, stocks and bonds, and then was very fortunate enough to be able to venture into the alternative space. Worked in hedge funds and arbitrage trading, worked in venture and startups, worked for a fund to fund where my job was a little bit about what we're going to talk about today is really going in and assessing a fund at a high level. And one of the things that we used to always sort of identify when descending down on funds is, can we really identify two key factors? Is what inefficiency are they taking advantage of and their particular edge? So we'll dive more into that. But one, Rocket Dollar, thank you for having me back, and Brendan, good to see you.
Yeah.
So let's stop talking about this guy and dive in. Agenda, we'll walk through some types of due diligence, what is inefficiency, what is edge, and then we'll give a little bit about and use some examples of the Kirkland Capital Group of what we believe are inefficiency and edge is, and then we'll break for some Q&A.
And another quick primer before we get started. As far as like the due diligence front that Chris is going to talk about, whenever a client is telling us, since we've done that last webinar, they're saying, hey, I'm really having some concerns about an investment opportunity. Rocket Dollar cannot provide investment advice, but we are often sending Chris's webinar to people. We went through a full hour on a lot of great topics, red flags, really good learning experiences. I would equate that webinar, Chris, to almost like eating your vegetables. Like, it's not always the most exciting stuff, but so important. We've probably sent that to over 40 people just individually, just saying, hey, watch this hour. You need to watch it.
Yeah, that's great. I mean, that was a great webinar. I mean, there's just a lot to cover in due diligence. I mean, it just can go on and on and on. I mean, there are people who do this for a living and they'll see hundreds and hundreds of funds, and it is no shortage of work. But one of the things for maybe a lot of people watching this webinar, one of the things to consider is you have to find what's reasonable for you. Coming in and trying to perform an institutional level of due diligence can actually be extremely time consuming and actually have a great deal of cost to it. So as you're venturing into alts, that's one thing to consider is, well, what works for you, and how are you going to get through this process of looking at alternative investments? So yeah, let's move forward. So generally in due diligence, most people really love investment due diligence. It's what most people are excited about. That's what got them interested. That's why they're looking into this deck. Then you've got operational. And out of operational, as things became more complex and more information started flowing through to potential investors, especially on the institutional side, you had this divergence into business due diligence. And we'll talk a little bit about that. And then one of the things that sort of is always encompassing, regardless of the investment you're looking at, is some level of economic due diligence. And once you understand the investment, operational, and business, you can kind of fit and perhaps even come to a conclusion of what kind of size you would want to be in whatever investment you're looking at from some of those economic findings. Let's dive in. So investment due diligence. As I said earlier, this is the exciting part. This is what you got excited about. This is the opportunity for return. Well, where's that return coming from? And one of the things that we used to always identify is lots of people can put up returns. Was it something that was unique or idiosyncratic to a particular process or opportunity? And that's that inefficiency. Is you got to identify what inefficiency is being taken advantage of by the fund manager that is allowing them to, in particular, put up what we call an excess return. So one of the quick definition there is you might be able to go buy an index that will represent whatever style of investment. Let's just say it's an equity index. You're going to go look at that. Well, that's the simple, public, low cost, liquid option. If you're looking at an alternative investment, you need to find someone who is accessing some inefficiency that is allowing them to create an excess return that would be beyond that benchmark. Otherwise, why wouldn't you just go buy whatever benchmark or index that was? Secondly, is you've got to dive in, you've got to understand the edge, and that's the team. And this is where it can get a little bit more complex. Sometimes, if you can't understand the investment, you should probably just walk away, because you're not going to be able to define what the inefficiency is if you can't understand the base of, the inefficiency and where the returns are coming from. But once you get that comfort level, you're like, okay, now I've got to dive into what I think is really hard, is the team. And what is it in particular that is allowing this team's edge to consistently and repeatedly generate that excess return and take advantage of that inefficiency? So those are the two big broad categories within the investment due diligence, aspect that you need to really identify. Moving on. So inefficiency refers to the situations where market prices do not accurately reflect underlying values. I'm not going to read the whole thing. This is the basis of the efficient market hypothesis. There are many people who disagree with it, agree with it. I just listed for fun out there. If you Google this, you can identify the weak, semi-strong and strong forms of the efficient market hypothesis. But more importantly, what I'm getting at is inefficiencies exist. They are generally caused by government regulations. One of the greatest ones that I took advantage of for years as a trader was a tax regulation inefficiency. So you have tax treaties between countries. Well, that can create up certain opportunities to generate a true arbitrage or an excess return. There are other inefficiencies of ways certain things are built, like closed-end funds may have certain parameters about when they have redemptions or something of that nature. There are so many different little occurrences that if you have the time and eventually you hope that you find a manager that has the network to get in, understand what those are, and be able to capture those on a consistent basis, you may have found yourself a very good investment. Now, one thing's with inefficiencies and one things you want to be sure to ask the manager is, well, what collapses this inefficiency? Is it cyclical? What else do you have that you're trading or doing that offsets when this trade might collapse? Because most inefficiencies I found through my career wax and wane. They're not consistent, or they're not always really wide. Obviously, the greatest inefficiencies are usually found right after you have a large market gap. Something occurred, like COVID or something like that. You're in this situation to where whatever inefficiency that you have been tracking or recognizing might be at levels that you've just never seen before. So those are the kinds of things when we are going out and you're looking at funds, the fund manager should be able to identify what their inefficiency is and why that's generating an excess return. That's a very, very simple question. And if a manager really can't explain in decent detail what their inefficiency is and why they're generating return, and it seems to make logical sense to you, well, you probably should find yourself a new manager, because then they obviously can't define his trade, or he doesn't really truly understand it.
And something, Chris, I've noticed is that these skilled managers and skilled traders or whoever, investors, have to take advantage of these efficiencies faster than they used to. So the information age has like completely changed that. A strategy that might have worked for 5 years might only work for like 2 or 6 months now. It really depends on the asset class. A lot of people are almost like dismayed by how fast the S&P 500 is moving now. And it's like you already have left the boat. So you also need to take that into a factor. It could have been a great inefficiency 3 years ago, and maybe it's already been mined out and a lot of competition in that space.
Exactly. And that is an excellent point. And I saw that happen in a multitude of trades that I did when I was working in a hedge fund. You would make a ton of money, information would get out, the nature of the trade would occur, then, well, okay, other people are doing the trade. And I think, as I've said in other webinars, you're looking at a situation of where you got to understand, is the trade what they call a zero sum? So no matter what really occurs, there's only $1 in the trade. And if there's one person in the trade, well, then they make the dollar. If there's 10 people in that trade, well, then they all just, pay 10 cents. It's usually shared. What I'm saying is there's only $1. So as more people enter, the trade becomes less lucrative. So exactly to your point, Brendan. And the thing is the information age really has created an accelerated nature. So really, really talented managers, definitely do rise to the top because of whatever it may be, knowledge, network, or systems. And we'll talk a little bit about that because that's a little bit on the edge side of how they're going to, maintain and take advantage of these inefficiencies. Let's move on. And some of this we've talked about a little bit. How to recognize, an inefficiency. It could be they have a particular network. One of the things that I love, and I've got a friend who manages a fund that does this, is more of a legal arbitrage. They can go in and they can do a trade that's called appraisal rights, and you can go in and you can file on the back end of M&A activity, and you can have a network, and you've got to have lawyers and understand the system and costs and how the court system works. And if you have that network, well, then you can rinse and repeat this particular inefficiency within that trade. Another one was if you're doing different redemption rights and things like that back in the day, you had to actually have the right phone number for the person who could give you the right tendered stock. And so some of those were big corporate actions officers at large banks and things like that. So you had to have those to enact your inefficiency. So these are the kinds of things where a manager should be able to go, this is what I have. This is why I can repeat this. Perhaps it's a system like we were just talking. It now takes greater reaction time. You have to be faster. You have to recognize the signs, more quickly as there are more participants and more people chipping away at the rock. So do they have a system or something in place that allows them to increase efficiency or speed to take advantage of their preferred inefficiency? And one is, well, I think this is knowledge is not everyone has knowledge of particular inefficiencies. So this is going to be part of your quest. Is you're going to learn a lot as an investor doing due diligence. You're going to become knowledgeable on a variety of different trades. But on the manager side, they should already all have a deep knowledge. That should be one of the given check the boxes that they've done this before, and they know how to recognize and capture that inefficiency. There's a lack of data. It still exists. I know we're in the information age and everyone's collecting data, but there are certain pockets out there to where it's very difficult to get enough data. And sometimes if you have a lack of information, that will, like the good old days, it'll allow you more time and perhaps a wider inefficiency to take advantage of. That kind of goes hand in hand where it's, that network or lack of data can create that limited access inefficiency. So there's only certain people who can play in that. One good example I had historically is we used to do a lot of different arbitrage through securities finance. And I was approached when I left that shop. They said, well, hey, could you go repeat the trade that you did for this other fund? And I said, yes, I know how to do everything. And I said, but I have a question for you. Do you have billion-dollar balance lines and credit limits with every major bank, around the world? And of course, their answer was no. Well, okay, well, yes, I'm aware of a number of different inefficiencies and a number of trades that people are taking advantage of. But for people like us that don't have those large credit limits, you just can't participate. And so that's something that some managers out there, and it's usually reserved for some of your bigger managers, they'll have an access to something that just others can't get. And so that might be part of their inefficient play that they're taking advantage of. So they can go do a trade that the people just do not have the infrastructure in place to pull it off. And I'm sorry, yeah, Brendan.
Yeah, I've noticed some clients will come in and, they'll start doing their first couple alternative investments, and they say like, well, how does Rocket Dollar get my data like into the portal? Like, how do I get statements? And a really not a very satisfying answer, but a realistic one, is a lot of investments that people do in the alternative space just don't have nearly a tenth or even hundredth of the data that the public markets do or the crypto markets do, which are crypto was kind of designed from the beginning to also have live updating data that people could view and look at. So if it's real estate, if it's private investments, some people make whole businesses now. They'll just create a database for an alternative investment that did not have one yet before. Then funds can come in and trade that investment more aggressively, when in the past it was very slow, not a lot of liquidity, not a lot of, and that can be scary as an alternative investor. You could go into a market where your manager might verbally know a lot, have a lot in their head, but there's not a lot to verify that you can just search online and Google very quickly. So then you have to kind of defer to personal referrals and experience, who's worked with them before, to see, does their knowledge really measure up, or are they just faking that high enough?
Yeah. I mean, even in my initial steps of doing due diligence on the space of microbalance bridge financing, I was very amazed. It was a good and a bad thing. I was amazed at how much data didn't exist. You couldn't actually get very precise numbers or consistent data on a lot of the questions I was asking for my own due diligence before I even started the fund. Now, the other side of the coin of that is, well, wait a second. If I can't get it, and then that means other people can't get it, which means, okay, we might be in a space to where there's a lack of data inefficiency. And then that comes down to my partner, Brock, who'd actually worked in the industry for a number of years. He had that network and knew how to build systems and things like that to overcome the fact that you couldn't really do a lot of research or pull information. So, so, I mean, it comes in lots of flavors. I mean, and I know we're talking about real estate, but this happens in venture. This happens in a variety of different alternative spaces. And each story will be slightly different, but end at the same place. Where, wait a second, okay, this is a story I've heard before. It just took a slightly different path. So if you do this enough, you'll start to recognize a pattern of these inefficiencies or a lack of them. And then lastly, fragmentation. This kind of encompasses a little bit of lack of data. You'll find niche markets that there's a supply and demand imbalance. It's broken. There's no one group that, or some form of oligopoly that controls a set section. It's very, very fragmented, and a particular investment space is run by a multitude of participants. That itself can create excess returns when things are very fractured, and there's no 1,000-pound gorilla in the room sort of dictating which way things go. Moving on, next slide. We talked a little bit about this, so we don't have to go into. I mean, we're obviously taking advantage of a fragmented market. We've got lack of participants. We've got lack of data. There's a supply and demand imbalance, more so now than you've ever seen in the microbalance real estate bridge financing. I mean, almost any private debt, these inefficiencies would now apply. They may not have applied too heavily, a year and a half ago, but you're starting to see, like I said, two tailwinds coming forward where, Fed raising rates, banks under pressure. The private debt world really got its start in 2010 with the Dodd-Frank rule and the changing regulations. And we're now back at that table where there's whispers of further regulations. We've already seen a number of different bank failures. And the one thing is, when banks start to fail, all the other banks, well, they turtle up quickly, because it's about being defensive, controlling and securing their deposits. And in those efforts, that creates a lot of, opportunity and excess returns to be created, by, participants, which, I mean, we're taking advantage of it. And I know a ton of other people in private debt, and that's not just in the real estate. I know venture debt guys are having a heyday. There's lots of opportunities in this space. Next slide. Edge. Now, I think this is more difficult because inefficiencies can be broad patterns, and they can be one of the things that we used to always do in inefficiencies is when you get down to the math. You could look at return attributions. You could break things into pieces. In fact, if you're looking at a long short hedge fund, one of the things that we would day one ask for is give me a breakdown of your attributions of long returns, short returns, and your net exposures. With that information and a number of different indices, you can actually really start to assess, are these guys making their money on the long side, short side? How often, the breadth of that, that return capture and arbitrage. So you can do a number of different things, and that makes it easier to understand. When you get into edge, you're now having to kind of wade through a different level of due diligence. It's a little bit more on the operational and business side. You're assessing teams, you're assessing available networks and systems to understand, is this a group of people who one of the things that people want to understand is, well, can these guys live through this current time? Have they seen a cycle before, or is this their first cycle that they've seen? And how are they performing, and how do they perform earlier? And as Brendan said earlier, one of the key things sometimes to get into edge, you might actually have to go out and really verify, get reference lists, go get their service providers, make sure they're actually working with the service providers they list out. How long have they been listing there? Sometimes they'll answer some questions around like, oh, well, how seamless and quick, does the team supply information to their fund administrator? Those are, you may or may not get those answers. Service providers get a little squirrely sometimes, even if they've been given, authorization to talk about a relationship. So you may not get as much answers as you'd like from some of those reference checks, but that's where you're going to have to get in there. You're going to have to do that verification. You're going to have to go in and, if they did background checks on their team members, hey, can I see those background checks? Can I, what information? If you don't ask, you're not going to get it. So you might as well ask. And, some of your bigger funds, well, their attitude is they may not share it. Some of your smaller funds might be much more open and transparent to share information as they might be growing, especially if they're an emerging manager. They're going to be far more open to answer questions and supply information. This is your opportunity to get in there and really assess, now that I understand the investment, how are these the guys that are going to make this happen? What's the breadth of their team? What's the depth of their team? Are they, if the trade requires international capabilities, okay, what's in the other offices? Who's in the other offices? That's one of the things that you have to be able to dive in and assess this edge. Does the trade take a certain network, like we explained earlier? Or is it more reliant on a particular system? Now, sometimes I go after systems anyways, because in today's age, the deployment of technology, we've already seen this in IoT and a variety of other things, and finance is always a little bit behind the curve with regards to the deployment of technology. But, it's one of those things where you want to go in and, well, what technology is being deployed just to increase efficiencies and operations at the company? How are they using today's technology to better streamline their business operations? Because if you're spending a lot of time doing manual labor, well, then you're not spending your time going out there and working your network to understand where the next trade might be, or how, I've got a trade that's flat. How do I go out and widen that spread? I mean, those are the things that your manager should be doing instead of trying to figure out like, okay, why can't I get, Excel to add up a column for me? So that's edge. It's a little bit, like I said, more qualitative, so you just got to get in there and ask the questions.
And I think you mentioned this a bit, but depending on how competitive their space is, some, like you said, the smaller managers might be willing to share. A very established fund might be afraid to give away certain information because they feel if they do, their competitive neighbor right down the street might just pump you or some operative pretending to be a client trying to invest. So, these funds, some funds compete all the time over information, employees, strategies, edges. So if you ever do get a bit of hesitancy, just understand that sometimes that cannot always mean they're trying to hide it from you. It could be that they're trying to hide some key parts of their strategy from another manager. and just asking a clarifying question, why can't you tell me that? They might be able to be honest with you and say, look, that's secret of the fund. We can't really give that out, versus here's what we can tell you.
Yeah. And there's definitely certain, like anything that's a zero sum or generating true arbitrage, you're going to have a secret sauce. You're going to have something that's unique that they're going to be less inclined to share. So yeah, I mean, you're going to run into that, especially your larger, more established, funds. Although your smaller guys, there might be. I've run into a few that were capacity constrained because their real edge and their ability to generate alpha was on the short side of their book, and so they had to be very careful what they were saying or how they were saying it, because they did have some unique tactics within shorting. And shorting is very, very difficult. Most people completely suck at it. If you do enough of this, you'll look at enough long short hedge funds. They should probably just stop shorting. It adjusts the volatility of their portfolio, but it's a detractor in the actual alpha generation of most fund managers. There are some out there, because I found a few of them, but it's super hard, and they're going to be reluctant to tell you sometimes, and that's okay. You've got to, if you're not comfortable with that, then move on to the next investment. But if it's something you feel like, hey, I can size this appropriately and I can put it in my fund, and I understand that there is this secret sauce, then that's okay.
There's a fund in Chicago where their whole first floor of their office is just for guests. The second floor, not a single guest is ever allowed unless you're a verified employee. Like, this is the kind of secrecy that sometimes.
Yeah. I did have one occurrence when I visited a fund. They were just getting started. They are a major powerhouse now, but I entered their office when they were just getting started. And they're like, yeah, you can't sit on your trading desk because you used to be a hedge fund trader. And I was like, okay, here's another way to think about that. If I can spend an hour of one of your traders looking at 2 or 3 different set trades, and you think I'm skilled enough, so I'm very honored, you think I'm skilled enough to reverse engineer your entire process, that I could walk out the door and repeat what you're doing. Here's my thought to that. 1, I'm not that smart. And 2, that means you don't have quite the inefficiency and edge you should if I could reverse engineer your trade that quickly. So if you really feel peckish and you want to go after someone, you can use that line. It worked for me. I did get up on their trading desk, and as I knew it, I was one of maybe 2 or 3 that had ever stood on their trading desk. But there again, it was in their early days. I guarantee you right now, if you tried to do that with that fund, I would just tell you to have a nice day. So
right. It's a great story. Sorry, we can continue here.
Let's do it. Yeah, I mean, some of the edge that we deploy, we've talked about a lot of this different aspects. We've obviously got my experience on the investment management side, analysis and risk management, and then Brock's history in underwriting, and developed an actual network within obtaining and sourcing loans and bridge financing. Brock's other skill that is brought to the table is really the implementation of efficient systems and technology. So we are a relatively small shop, and we kind of run ourselves like a technology startup in the finance space. So we are always trying to push the edge and look at new systems for increasing efficiency. I'll skip that alignment one. Go to process and procedure. We're very big on process and procedure. So much to the fact that, our little tiny fund, we already have a due diligence questionnaire that we've created. It's something that's very easily for us to update when new employees come in. We have just an entire write-up of, SOPs in place. And so all their procedures that they need to do to understand their job. We're very, very big on following process and procedure. So the combination of that process and procedure with technology allows us to achieve a lot with very few people. And that alignment, one of the things I think is really important is really looking at the standpoint of saying, listen, we're in investment management, so we've got investors as clients, but on all the way on the other side, we've got the people who are borrowing money from us. And we want to create an alignment all the way from that borrower through a broker, because we source all of our loans through loan brokers, into the fund management all the way to the investor. We want a complete alignment, and a lot of that is created through transparency. And even the way we put our loan docs together, the broker and the borrower, everyone is in the same camp. Everyone's being taken care of. Everyone can see how the process is going to work. And so that efficiency and that belief in alignment of our entire aspect really allows us to create repeat business. And it also allows us to be incredibly transparent with our investors. And, that actually at the end of the day builds comfort, trust, and better returns over the long term. So there's a number of different things that we're deploying in our edge. Let's jump to the next. We've hinted at this a couple different times. We are our fund is a real estate income fund. We invest in microbalance, first lien mortgages. They're all bridge, so we do 12-month loans. We run very conservative valuation since day one, so that's been exceedingly helpful in this time where you've seen rising cost of capital, definitely putting pressure on valuations. So we've been able to ride easily into that issue. We've got short loan duration, so we're not really trapped in anything long to where we had booked up a 5-year loan at a lower rate. So as rates have gone up, we've been able to increase rates and bring better returns to our investors. We don't have an incentive fee, so those fees flow directly to the investors. So as we write loans at a higher gross rate, that increased rate is, flowing directly to the investor's pocket. Everything we do is senior debt. We got defined exit strategies. Everything. We don't do any raw land or construction because, especially in this time period where people are talking about default rates, increased default rates coming in, potential recession. Well, that's okay. We run relatively low LTVs, and we don't, like I said, don't do any raw land or construction. So if we have to end up taking a property, it is something that's income generating. And we try to maintain pretty good diversification across property type and geography. So, that's really a quick rundown of, what we're doing. I didn't know if anyone had any questions, or Brendan, you had further topics you wanted to dive into about inefficiencies and edge. You really can talk hours depending on what strategy you're looking at, because there's different inefficiencies in venture, in hedge funds, and in private debt.
Yeah, and I think we touched on it a little bit, but I know you helped us write a blog article recently. Can you just repeat again, I don't think some investors know how bad the credit crunch really is right now. So, the Fed has pulled back. That's causing banks to pull back. Mm-hmm. And, America has a lot more regional or small banks than a lot of other countries. So most other, England, Canada, Germany, they have like a couple major banks that do pretty much all the business. In America, there's, I believe it's 4,000 or 5,000 of, banks in the entire nation. And every one of these regional banks has a book of business where they go and they do lending to various local businesses, parties, houses, mortgages, etc. But local businesses, whether they're real estate or other type of businesses, are getting a lot more pushback and trouble from those lenders, right, Chris?
Yeah, no, there's a couple different things. Let's start from the big world that, all the headline news. And I just, in my newsletter that just went out in May, if you can get access to that, I really talk about this subject a lot and actually have some pretty interesting charts. In the big dollar world, where you're talking like CMBS, which, those loans usually average in the $200 to $300 million range, you're looking at a situation of where you're coming up to what they call a debt cliff. You're looking at a issue where a lot of debt in the billions of dollars is coming due, and it's all going to have to be refinanced, and it's going to have to be done at a much higher rate. And you're also looking at a situation of, well, how badly is that going to hurt the assessed valuations of a number of different properties that represents? Now, most of these headline newses and most of this CMBS issue, that's like your gateway city, your, like Seattle or any kind of like Atlanta. Major cities are struggling from this standpoint. There's almost no news you can't look up about New York or San Francisco and see hotels failing, office buildings completely empty. So there's definitely a problem in the very, very large world. And you know, that big dollar amount in these gateway cities, there's going to be a prolonged issue. People are now going to have to figure out, what are we going to do with these office towers? Because it's a pretty complex problem and it's a big dollar problem. You can't just have, you know, Brandon and I can't come together and write a check and solve this problem on a building. I mean, it's just too big. You're talking about institutional level. Now, coming down the curve, you are starting to see where, you know, a lot of people are stepping into mezz debt, trying to do longer term 2 to 5 year, you know, covering that middle ground for people who need to refinance. We have seen a ton of loans refinanced. We've seen a ton of people need extensions. We've seen a few loans even in our portfolio. Luckily, they've paid every single month. They've been performing. We love the borrower. We love the property. So we actually just internally refinanced it. And you're starting to see that more and more because that normal exit from that conventional lender, whether that was a community bank or a regional or super regional bank, they're just not at the table the way they were before all of the Fed hike and credit crunch in 2022. It just, you know, we started seeing it in November, where we were, you know, Brock and I would often talk about, well, what is this loan? I mean, it would come from a major super regional, and it was a multifamily that was fully occupied. And the guy's like, well, I need a bridge loan because I now have to increase my DSCR rate to 1.25 or 1.3 before my bank will now finance me. So it's not that banks aren't lending. They're just making it harder to lend. And I'm sure some out there have kind of closed off entire sections of their book. But that is definitely occurring, you know, as it comes lower and lower. Now, that creates opportunities where in our space, in the microbalance space, where we're seeing loans we normally wouldn't have seen. So you're taking lower risk based on the quality of the borrower, the type of the property, and the situation of the property, yet you're still out there charging, you know, double-digit rates. And they kind of have to move in and accept this. It's not great for them, but you know, it shouldn't break the bank for them either if they're already at a performing level. So there is opportunities on the back of this, but this credit crunch is not over. I know the Fed's battling between, hey, do I raise rates and fight inflation? Because if I raise rates, I'm just going to exacerbate the credit crunch. So it's a tough situation and the decisions they have to make. There will be pockets of opportunity, but if you're, say, in a big ETF that's looking at major office buildings in gateway cities, you've probably already taken a pretty good hit. And who knows when you'll be recouping that in one form or another. That's going to be a tough space. So yeah, I hope that answered your question, Brennan. I mean, it is prolific, but most of the pain and suffering right now is really in your bigger debt areas.
Okay. Yeah, we had a question come in from Jason. I'm going to read it quick and then I'll repeat it here for. Okay. All right. So this is about an international investment, but I think it's more on the due diligence and the edge side. Okay. So Jason asked, I'm looking at a private equity company based in Germany. As an investor, what should I consider with regards to being a U.S. citizen, investing through my IRA, and then providing my legal status outside the U.S. as a qualified investor, what to consider to be tax efficient? So I'll handle the IRA side, and then maybe we can just talk about due diligence and a little bit international. So Jason, a lot of people come to us because they can invest internationally. You can do that with a self-directed IRA. Investing in a professional fund is usually the easiest. We find it's a lot harder for people to do a deal kind of more on the private handshake level. You know, in America, you can just go up and draw a contract, but your bank transfer will go through immediately. When you go to another country, just sending the money to Germany is a little bit harder. To Germany, a major Euro country, quite easy. Once you get to other countries like India, Italy, you know, it starts to get more and more difficult. Mexico and Canada are not too bad, but as people spread out around the globe. So, Chris, I guess to make this question relevant to you in the material we've been discussing today. Have you ever kind of considered international investments and kind of the extra due diligence or like maybe an international edge that you've had to look at?
Yeah, I mean, we've done investing in, I would often fly to the UK and various areas looking at a number of different funds that we were investing in over there, more in the hedge fund space. One of the things I would say is, on-site verification becomes monumentally more difficult for most investors. So that's a problem. So you've got to go in and you've got to figure out, how am I going to complete verification at a level that makes me comfortable? And a lot of that is going to be, investor references. That's going to be one of the things you should get a hold of is, well, how many other US investors do you have? Can I have access to a number of those people to understand the process and procedure, how information has been disseminated? Have they been comfortable with the transparency? And then assessing the inefficiency, really, that comes down to you've got to understand. Well, you had mentioned private equity. So, okay, they're a private equity company investing in corporate, in the equity stock of a private company. Great. What's the nature of that portfolio? Look up those companies that are, in the portfolio, see how those are going forward. Try to get the information and understanding of what are they looking at and what do they think? Why do they invest in those companies? What is it that they have network-wise that will give them access to something that's not very flooded or easy for other people to, obtain? Now, if you're dealing with a very, very large PE fund, well, there's a saying, it's like, okay, that might be safer in some areas and easier to do due diligence, but they may not be that high on the inefficiency scale. Now, they're like that. That's just generally speaking. Larger funds are like trying to turn an aircraft carrier. When you start turning, everyone can see it turning, and it takes a while to turn. So they can't really move quickly, and then a lot of people can come in on their trades, which generally lowers, excess return. Doesn't mean they're not, putting up a good return. It just makes it very difficult for them to go unnoticed and create a true inefficiency. Now, being of size, I'll just switch gears and go into sort of more of the venture side. Being of size and having the notoriety and then what they call network capital in the venture space is probably one of the most consistent and well-known inefficiencies that the larger venture shops have. What allows them to continue to see the best deals. They're putting, they're getting access to the best companies, the best startup teams, because they've got the big checks and they've got a history of performing well. So if you're going to start up a company, do you eventually want to take money from someone who's really going to be able to have the pockets there to nurture you at every step of your company? Of course. So that's called an inefficiency called network capital. In private equity, you can make kind of the same assessments of like, okay, well, do they have that inefficiency in place? Do they have the ability to get the best deals, and why? And and understanding that network capital. So I mean, that's one of the biggest things. But there could be something unique to Germany, and that can be assessed. I don't personally know. I've never dove into Germany in one way or another, so I can't really speak to a specific country inefficiency. But there could be one there as well, and that's something worth noting.
And I'd say, I tell this to every international investor. I just say, I just ask, like, have you been there? Have you lived there? Do you know someone there that you're very deeply close to that's knowledgeable there? And most investors that are excited bringing us an international deal do have that experience. I would say it's best to stick to what you know, especially when you're jumping a country barrier, because checking on that investor network becomes many times harder. And also for you to get a good judge of like, well, who else is investing into this fund? Seeing really sophisticated, smart investors go, get excited about an opportunity, then you're kind of following them. If you can't determine who's really coming into this fund, like Chris is saying, asking who's an American investor, you're going to have a lot of trouble to verify that. And you're going in like a little bit blind. And then you might find out a year or two in, you're going, wow, there's a cultural difference or a market difference in this country that I had no idea about. I wish I would have known that 3 years ago when I first kind of jumped into the opportunity. And I think that ties back to any investment in America, in our borders. is if you have absolutely no clue about this asset class, you need to start small. You need to dip your feet in, maybe do a smaller investment, really learn the space. As I've done like a new real estate deal myself in my own personal portfolio, you learn so much about that entire industry in the first 2 years of that investment. It's best not to jump into 6 more until you really learn that lesson. So do one investment in Germany. Don't do 12 all at the same
time. And one thing that just came to mind also is, as I mentioned earlier, one of the efficiencies can be rules and regulations, particular to a country that's not the same as the US. So that's another thing that you're going to have to, dive in and understand. Is that a component of what this fund has available to it as a possible inefficiency, is a particular rule or regulation in Germany or whatever country you're looking at that helps this trade, that we maybe don't have in the US.
And Chris, I'd like to bring up a really good topic I thought about myself is in alternative investments, there's kind of a stratification of there's big accredited only deals, and then there's small retail deals. And sometimes I've noticed, the edge sometimes of a particular platform is, some of these retail platforms have really good deals and some don't, frankly. Sometimes I see like the only edge is, well, they're just cutting this up investment for smaller people. And sometimes, if I don't really know their investment that well, I have this fear, or, because I've considered investing myself in some of these. Well, is this platform getting the best deals, or are they kind of giving the scraps to the retail clients just because we can cut this up into $500, $1,000, $5,000 increments? So would you kind of talk about an edge just as far as like check size? How does like the minimum investment in the check size really change things for the investor and how they look at this process?
Well, anyone tells you size doesn't matter, as I always say, one of my hobbies is martial arts. You've never fought a 300-pound man. Size matters. Yeah, one of their punches will knock you across a room. But all joking aside, it is always a concern of what, as I mentioned earlier, that network capital in the venture space. Are they getting the best deals? And one of the things that's assessed in emerging venture a lot is deal sourcing. How are they getting the best deals, and why? Or in particular, are they hunting in an area that the big money doesn't care? So you might have a perfectly great deal, but it only takes, a couple $1 million to pull together. So you can actually get fractionalization down to a small dollar amount and still achieve the raise. So, I mean, it's one of those understanding the sourcing aspect of, okay, if I'm looking at a particular platform or I'm looking at a particular manager that's is emerging, understanding how they're sourcing and why those deals are worth having is super important and can supersede the check size. But you do always worry that, am I just getting the class B, class C type deals? And that's across everything. Am I seeing, in venture, am I seeing the companies that are worth having if they're small? Yeah. Now, there's a lot that are. I know a few, but you've got to dive in and assess that. Am I getting a good real estate deal? Well, yeah, you might be getting one. I mean, we write relatively small checks. I think our average check size is about 550,000. And people are like, well, wait, I mean, now, and of course, they're not thinking that now because no one wants to be in the mega trades. But, we get a lot of questions around, well, why these loans? Why secondary and tertiary markets? And we would talk about how we're sourcing those and why these trades are not any less risky or more risky in any way than some of your bigger trades. A lot of the factors are the same. And in a lot of cases, we're going in and writing loans against a property that could be at a 10, 12, 14 cap because that particular regional area, an hour outside of Atlanta, things weren't driven to a 2 or 3 cap. They stayed at, 8 or 9 or 10 and now have gone, up in the recent time period. So there could be nuances where You got to dive in. You got to understand, wait a second, where does the small check actually still have power? But it is, and Brandon brings up a very good point. I mean, there is, you always have to be wary. Am I working with someone who's just getting the subclass deals because he couldn't get the better deals? Well, here's my answer to that is define better.
Yeah. And, you know, for terms to recognize, like some people call it like a sidecar or an SPV, they'll be raising a huge sum. And then it's very difficult to, you know, they deal with big institutional investors that have whole teams, and, you know, they might have 6 parties, just very giant, you know, $300 million each. It's very difficult for that firm to suddenly pivot and deal with 200 retail investors, you know, that have checks of 10,000 or 100,000 or whatever, just much smaller than they're used to. So you'll see some big alternative funds do what's called a sidecar, an SPV, and put all of the smaller checks into that same deal. So you're kind of along for the ride of the bigger manager. And then you'll have other firms that frankly don't want to be anywhere close to that. They'd rather be in the small pond with less competition, you know, kind of hiding away from those big management firms that could snatch up their deal and just take it away from them.
Yeah. I mean, there's good and bad to being, you know, around the feet of, you know, a large animal. Well, you probably protected from other predators on the outside, but you also can just get stepped on. And so it's something to really dive into the documents and the understanding, you know, and this is getting kind of a little bit more on the due diligence side. Not really an assessment of inefficiency or edge, but if you're going in through some type of feeder structure and, you know, running side by side with behemoths into a trade, it does give you some level of solace that your due diligence is supplemented with, you know, other people who are descending with multiple people in their team to complete the due diligence. But you need to understand not only that comfort, but, you know, do you have the same rights? Do you have the same fees? What side letters are in place? Do they have liquidity preferences? If things go bad, they get out before you do. Things like this. I mean, those are the kinds of questions you just gotta sit down and think, like, wait a second, how could I get hurt when I'm the smallest guy in the room?
Yeah. And just asking these questions about, you know, how big a manager is compared to their competitors, getting a better sense will help you just give like a bit of a story and then to talk about their edge of, you know, are they putting your money in the right place, and are they coming with the right check size that think is going to give you an advantage to join them along that?
Yeah, most definitely.
Okay. Any more questions from the audience that we'd like to talk about? Kind of covered a lot. These are a lot of different topics, but this edge and inefficiency, it's a great, you know, something people are considering every month, you know, every time they're trying to make a move with their self-directed IRA.
Yeah, I mean, and in the alts world, these are the two things, and it gets fairly complex, but at a very, very high level, if you can identify who's someone who has an inefficiency and can create an excess return, and they have the edge to consistently and repeatedly provide that, you may have found something.
Yeah. So now everyone's going into AI now, and we're just going to have 5 AI funds tomorrow. But all right, Chris, thank you for coming by and stopping for another Rocket Dollar webinar. This is great.
Appreciate it.
Really great material. Appreciate you talking about these high-level topics.
Yeah. And Brennan, as always, great to chat with you.
All right. And then we have, I'm going to, it's recording on my screen, so I'm going to bring up the contact on the slides again. And if you just look at that on YouTube, you'll be able, we're going to have this recording up within 24 hours on YouTube. There's also, you can contact Kirkland at their email up on the screen, or go to their website and reach out to Chris to talk with them further. Thank you, Chris. Thanks for stopping by.
Thank you very much. Everyone have a great day.